The global economy is a complex web of interconnections. Goods and services flow freely across borders. This intricate system has brought prosperity to many corners of the world. However, it is also vulnerable to disruption. In recent years, the world has witnessed a rise in protectionist policies, most notably the trade war initiated by the United States under President Trump. These actions have sent shockwaves through the global economy, highlighting the interconnected nature of our modern world. The tariffs, essentially taxes on imported goods, have disrupted the delicate balance of international trade. They have led to higher prices for consumers, uncertainty for businesses, and tensions between nations. The automotive industry, heavily reliant on global supply chains, has been particularly affected. The interconnectedness of the global economy means that actions taken in one part of the world can have far-reaching consequences. The impact of these policies extends far beyond the immediate targets. Emerging economies already grappling with their own challenges are particularly vulnerable to disruptions in global trade. The uncertainty generated by these actions has the potential to dampen investment and stifle economic growth worldwide. Therefore, it is crucial to understand the full extent of the global impact of these protectionist measures. This essay will delve into the specific consequences of the tariff war, examining its impact on global supply chains, consumer prices, economic growth, geopolitical tensions, and overall welfare. It will also analyze the responses of major economies like the European Union, China, Japan, and South Korea, highlighting the specific concerns for the UK economy. Ultimately, this essay argues that international cooperation is essential to mitigate the negative effects of protectionist policies and ensure the continued prosperity of the global economy. The automotive industry, a symbol of globalization, has found itself on the front lines of the tariff war. Cars are no longer the product of a single nation. They are assembled from parts sourced from all corners of the globe. This intricate web of suppliers, manufacturers, and distributors forms the backbone of the automotive industry's global supply chain. The imposition of tariffs has thrown this delicately balanced system into disarray. Take, for instance, a car manufacturer in the United States. The steel used in the car's frame may be sourced from China, the electronics from Japan, and the seats from Mexico. With each tariff imposed, the cost of these imported components increases. These increased costs are then passed on to the consumer in the form of higher car prices. This in turn can lead to decreased demand, impacting production and employment levels throughout the supply chain. The impact is not limited to the automotive industry. Many other sectors, from electronics to agriculture, rely on similarly complex global supply chains. Tariffs disrupt these chains, creating bottlenecks, increasing costs, and delaying production. The uncertainty surrounding trade policy makes it difficult for businesses to plan for the future. This uncertainty can lead to a reluctance to invest, further hindering economic growth. The disruption of global supply chains is a stark reminder of the interconnected nature of the global economy. Actions taken in one country can have ripple effects that are felt across borders and industries. The tariff war serves as a cautionary tale, highlighting the importance of international cooperation and the dangers of protectionist policies in an increasingly interconnected world. Tariffs, often touted as a means to protect domestic industries, ultimately act as a tax on consumers. When the cost of imported goods rises due to tariffs, businesses have little choice but to pass these costs on to consumers in the form of higher prices. This is most evident in everyday goods that rely on global supply chains. Clothing, electronics, and even groceries become more expensive, putting a strain on household budgets, particularly those of low and middle-income families. The impact on consumer prices is not limited to imported goods. Tariffs can also lead to price increases for domestically produced goods that rely on imported components. For example, a tariff on imported steel will increase the cost of producing cars domestically, even if the cars themselves are not imported. This ripple effect further exacerbates the burden on consumers. The rise in consumer prices can lead to a decrease in consumer spending, which can have a negative impact on economic growth. As consumers tighten their belts in response to rising prices, businesses may see a decline in sales, leading to reduced production, layoffs, and a slowdown in economic activity. This interconnectedness between consumer prices, spending, and economic growth highlights the far-reaching consequences of tariff wars. Furthermore, tariffs can contribute to inflation, eroding the purchasing power of consumers and undermining the stability of the economy. When prices rise across the board, it can create a wage price spiral where workers demand higher wages to keep pace with the rising cost of living, leading to further price increases. This vicious cycle can be difficult to break, and it can have long-term consequences for economic stability. Trade wars create an environment of uncertainty that can be detrimental to economic growth. Businesses thrive on predictability and stability. They need to be able to plan for the future with a reasonable degree of certainty. When trade policies are in flux and the threat of new tariffs looms large, businesses become hesitant to make long-term investments. Investment is the lifeblood of economic growth. It fuels innovation, creates jobs, and drives productivity gains. When businesses hold back on investment due to trade uncertainty, the entire economy suffers. Projects are put on hold, expansions are delayed, and new ventures are scrapped. This can lead to a slowdown in economic activity, reduced job creation, and stagnant wages. The impact on investment is not limited to physical capital, such as factories and equipment. It also extends to human capital. In an uncertain business environment, companies may be less likely to invest in training and development for their employees. This can lead to a less skilled workforce, further hindering long-term economic growth. The uncertainty generated by trade wars can also have a chilling effect on global trade itself. As businesses become more risk-averse, they may be less likely to explore new markets or expand their operations internationally. This can lead to a decline in global trade, which can have negative consequences for all countries involved, particularly those that are heavily reliant on exports. Section 5. Rising tensions, the specter of conflict. Beyond the economic realm, trade wars can exacerbate geopolitical tensions and increase the risk of conflict. When countries engage in tit-for-tat tariff battles, it can erode trust and cooperation, creating an environment of animosity and suspicion. This can spill over into other areas of international relations, making it more difficult to address shared challenges such as climate change, terrorism, and pandemics. The history of the 20th century provides ample evidence of the dangers of protectionism and economic nationalism. The Smoot-Hawley Tariff Act of 1930, which raised tariffs on over 20,000 imported goods, is widely seen as having exacerbated the Great Depression and contributed to the rise of global tensions that led to World War II. While a full-blown trade war is unlikely to lead to military conflict in the 21st century, it can create a climate of mistrust and hostility that makes diplomacy more difficult and increases the risk of miscalculation. In an interconnected world, where nations are increasingly reliant on each other for trade, investment, and security, cooperation is essential. Trade wars undermine this cooperation, creating a more fragmented and unstable world order. The current trade war has already strained relations between the United States and its major trading partners, including China, the European Union, Canada, and Mexico. These tensions can have far-reaching consequences, hindering cooperation on issues of mutual interest and increasing the risk of conflict in the long run. As we delve into the concept of global welfare loss, it's crucial to understand the broader implications. When economies falter, it's not just numbers on a chart, it's real people facing hardships. The ripple effects can be felt across borders, affecting global stability and prosperity. In times of economic turmoil, a measured response is essential. Governments and institutions must act decisively, yet carefully. Policies need to be balanced to support growth while ensuring long-term sustainability. It's a delicate dance requiring insight and prudence. During crises, there's a natural tendency for nations to turn inward, focusing on domestic issues. While this is understandable, it can lead to isolationism and protectionism. Such approaches might offer short-term relief, but often result in long-term disadvantages. In our interconnected world, cooperation is more important than ever. By working together, countries can overcome challenges that seem insurmountable alone. It's a call for unity, for collective action, and for a shared vision of a prosperous future for all.